everybody, and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today we're going to be taking a look at Eversource Energy stock. I've had multiple requests for this one. If you have a stock you'd like me to take a look at and make a video on the channel, just put it down in the comment section. I'll get the ticker on the whiteboard behind me, and eventually I'll make a video. If it's a stock that's in the S&P 500 like Eversource is, I post those on YouTube for free, and the rest I post in Patreon, which is $5 a month, and in the full Cyclical Investors Club service over on Seeking Alpha. If you join Patreon, you can get a big discount to the full Cyclical Investors Club service. And then if I make videos and analysis that are stocks that are not in the S&P 500, those go on Patreon as well. As always, this is not individual investing advice. This is just how I analyze stocks. We're going to be using the Fast Graphs charting service here again for this video, and I have a 25% off link for that down in the description if anyone is interested in that. So Eversource. So this one's pretty interesting. For some reason I hadn't been tracking it, even though it's in the S&P 500. Probably because when I was building out my spreadsheet a few years ago, this was really just extraordinarily expensive, and I thought I would never, like high 20s PE for a utility, right? That's pretty rich. So I went and did the work, and I added it to the spreadsheet, and then so I think there's a couple notable things and maybe investing lesson takeaways from this one. The first thing I would say is, whenever you see, first of all, like most or a lot of utilities, they have very steady earnings. Way back in 2005, they had some sort of, I didn't go look up what it was because it was so long ago, but some sort of earnings decline here, some sort of write-off or something. But if we bring it to more recent times, which is usually what I do, if you go back, say, to like 2014, 15, you can look at the earnings growth rate, and it's extremely stable, and it's about 5.5% per year. So that meets kind of the basic standards that you want. If you think inflation's like 3%, earnings growth is growing faster than inflation. And so really at the most basic level, you just want to buy these type of stocks when they're cheap, when they're out of favor with the market. And if we went back to, I actually don't know what this is going to show here. But yeah, if we go back to maybe even in here, it was trading at like a 15 PE instead of a 25 PE. That might have been like a reasonably fair value. It's not super cheap, but you also often with utilities, you get a little more stability, and especially with the market, you get more perceived stability. So when people get scared sometimes, or they want something they feel is safe, they'll buy utilities, so they don't tend to be as volatile of stock price movements. And then, of course, back in 2009 or 10, you could have got it down at like a 10 PE. So that would have been cheaper, But the problem is, along with that stability in earnings growth, relative stability, I should say, and lower volatility, usually you get a limit on what this earnings growth is really going to be. That 5 to 6% is generally the rule for most pretty good utilities. And you're unlikely to get more than that. I would say the best you can get is maybe 9% if you can get a faster growing one. So your upside is definitely limited with this type of stock. But we see now that we are down to, when you just look at the PEs, on the adjusted earnings, we're down into those Great Recession type levels, right? So you can see why someone would be interested in maybe this is worth buying. So I would say, as a general rule, as an investor, when you see something like this, it's kind of unusual where the stock price, now interest rates have been rising, so that's going to send usually utility stocks down, and it was already pretty expensive, so all that kind of makes sense, right? But so that's one explanation, but you should always kind of assume, at least at first, that the market knows what it's doing over the next year or two. Usually there will be an explanation for this. So the easiest explanation is if you just go to the basic unadjusted earnings, you can see why the stock fell, right? So they had some kind of big write-off or something that they took, or some big expense, right, that cost them a bunch of money this year. So now when they made their adjustments, they just adjusted that out. But the fact is, for whatever reason, I didn't look up exactly what it was. I saw that they're selling some of their wind farms, or a wind farm, or that could be part of what's going on here. I didn't dig into it a lot, but we can see that, okay, this isn't the market just being totally irrational. We can see what the market is really reacting to here. They're reacting to this basic gap earnings decline that happened this year. But you can also view that, because the price actually did move, as maybe an opportunity to buy it, because if you assume, well, if everything returns to normal, this is one of the reasons why I usually use adjusted earnings, as long as there isn't anything totally crazy going on. You could say, well, if things return to normal next year, then over the next couple of years, probably this stock will go back to kind of quote unquote normal. And I think that's true, which makes it pretty interesting. But the problem is, like, this normal up here, like, isn't normal, like, long term. So a utility growing 5% a year shouldn't be trading at a 4 peg or a 5 peg ratio. These mid 20 PEs, and this is what, like, Alphabet trades at, right? And we can see that while the risks are different types of risks, it's not a risk-free business. Additionally, I'm not sure what the P. Yeah, so the P was more like 17 to 20 back here when interest rates were at 0, but now interest rates are higher. It's like everything is basically working against kind of this type of stock. And then you look, and they have quite a lot of debt, right? So a lot of times the market doesn't really care about utility debt, has been my observation. And so that's kind of a judgment that each individual investor needs to make. I've actually been debating with myself exactly what to do. I've been just fully discounting the debt like any other company so far. But I would probably be willing to, like, only discount half maybe what I would normally, because they're always going to have some debt, and they're going to be allowed to pass the costs on to consumers. So it definitely is a little bit of a different dynamic for a utility company. But on the other hand, debt still costs interest, and when the rates go up, the cost of the debt goes up and the potential earnings growth goes down. So maybe at some point in the future, I'll kind of split the difference and figure out how I want to deal with that. But I'm going to show you both estimates here when we get to the spreadsheet. So in terms of estimating, like, the future returns, whenever my spreadsheet decides to load here, if it decides to load, if it doesn't, I'll just talk about it and see what happens. Sure, if I can get don't know if it's going to do it or not. Oh wait, it's going to try here, so we'll give it a second. So let me get down to the bottom. So I had it set up down here. Okay, here we go. So we have the 5.5% earnings growth rate. Okay, we have, now when I make the adjustments for the debt, it actually takes that stock price in terms of calculating for a valuation, right, up to $132 per share, because they have there's a big difference between their total enterprise value and their market cap. So this is a very big adjustment. I'm going to show you what the numbers look like with this adjustment, and then I'll go and just take it out completely and then show you what it looks like then. So the way I like to think about this is, if I bought the whole business for $100, including all the debt, they would be able to pay me back with their earnings about $3.41 on my $100 per year, and that would grow at, that $3.41 would grow at 5.5% per year. So I pull forward that first 5.5%, so you earn like $3.60 the first year. And then I want to see where we end up after 10 years, which is you make about $46 or $47 on your $100. So that works out, when you do the math, to about a 3.9% 10-year earnings CAGR if you include the debt. That would generally be below like my sell level, which is about 5%. So even after the big price drop, even using adjusted earnings, if you include kind of the debt and that type of stuff, it doesn't look very attractive still, even after that decline. Now let's look at it if I just completely take the debt adjustment out. So we'll change this to 1. So this is just, so you can see now the stock price is exactly the same as the actual stock price, right? So now we're up to a 7.5% 10-year CAGR. So now 8% would be my buy threshold, so it still wouldn't be at the buying threshold, but it would definitely be a lot more attractive than using the other way. And unfortunately, there's a big gap between these, right? So on one, we have about a 4% CAGR, and then the other we have like a 7.5%. If you took like the difference between them, which I haven't not done ahead of time, but if we think about it, like maybe we'd be looking at 5.75 probably, give or take, for the for that CAGR, and that's about where the S&P 500 is on average. So that's one of the reasons why I'm like, well, maybe someday in the future, if I just took the half of the difference of, counted half the debt and then assumed the other was just the market didn't care about, I might make that adjustment at some point in the future and kind of dial that in a little bit more. So for me, not super attractive yet, no matter how you look at it. Probably we can see how the market is treating the stock. But I would say that, you know, if you wanted to, if a person, I don't do like shorting or pair trades or stuff like that, but I think you could, you know, make the case maybe for a pair trade if the market, because the market has punished this utility a lot more than other ones. And if it does recover kind of regular earnings over the next couple of years, you could see it on a relative basis improve relative to other utilities. So for traders and stuff, there might be an opportunity for something like that there. But for me, this probably is fairly valued when I just look at the holistic picture. And the way I think about it is, you know, if I'm going to buy a business with a 5% to 6% likely CAGR over the next decade, just using the math, I want to get a higher quality business just generally than a utility, you know. I think Microsoft is a little more expensive right now, but there are definitely, you know, just generally higher quality businesses that are kind of right in that. Even the S&P 500 index as a whole, if you just bought the whole index, it's probably valued about the same as this. So I don't, or more attractive, depending on how you want to look at it, even though it's at all-time highs. And so for me, you know, you can take all the individual stock risk out of it. Yeah, I don't think there's just anything like super attractive about the utility at this point. I did not do a dividend analysis on this one. We can glance at it and see. So they're at about 4%. Or almost 5%. So 5% dividend growing at 5.5. Well, we can look at we know what earnings growth. So growing at 5.5% each year isn't going to be like super attractive either. It's going to probably be about in line with, you know, the earnings analysis that I just did. Okay, hopefully you found that interesting and useful. And if you did, hit the subscribe button, and I will see everybody later. Bye.